Thank you everyone for joining today on a Private Equity 101 webinar. I think this was a great topic as it's becoming more and more of a conversation, not only with our clients who are invested in it, but our business owner clients as they're getting reached out to by private equity groups to buy in their company. So again, what Ausperity is big on is the educational side on what we're doing and the thought process on why we make the decisions that we do for clients. So I thought it would make sense to have, a group like Bridgeway Partners who does a lot of this great work for owners in these situations. So again, a lot of the conversation early on will be them, doing some education on that end, and we'll finish out with Q&A as well. If you have questions, feel free to put them in the chat as we're going through. And with that, I'll let Mike and Tyler take the show.
Kevin, appreciate it. We're both really excited to be here today and lead the charge on this Private Equity 101 or crash course. We want to go ahead and get started with a quick video. We think we'll find some value in this and set a bit of a comedic relief from the get-go. Then we'll give some intros, just who we are personally, our professional background, and what gives us the credibility to be leading this webinar. A little bit about Bridgeway, and then we'll jump right into the material. Well, that hopefully sets the stage as to what we're going to walk through during today's webinar, at least some of the questions we're going to hope to answer. And I think it just goes to show that private equity can mean many things. And the folks who currently own businesses or even in some instances sold to private equity might not know the answer to some of these questions. And so we hope you find the time fruitful today, and we'll walk through those items. And we're certainly happy to answer questions if there's time on the tail end here or follow up separately. But a quick intro on Bridgeway Partners and what gives us the credibility to stand in front of you today and share information on this topic is we're a sell-side M&A advisor. What that really means is we're the business owner's advocate in a sale process, managing the process from beginning to end. We've done combined $1.8 billion in closed transactions across 100 deals, all in the private equity ecosystem, over 15 years of M&A experience. I'll kick it to Tyler to go ahead and introduce himself personally real quick. I'll do the same, and then we'll be jumping headfirst into the materials.
Yeah, thanks, Mike. I do feel it's important for you to kind of get to know who we are and what makes us tick and a little bit about our journey. I'll start with the center photo there. That is my family, and we're all gathered around my dad. He is in the middle. There's a reason for that, is he's the center of all of our universe. I'm very proud of my father. He came from very humble beginnings, became an entrepreneur and did very well for himself. He didn't have the opportunity to go to college, and so there was no question. My sister and I were going to go to college, whether we wanted to or not. I initially chose the sciences because I didn't know what I wanted to do. And that actually took me through a master's and eventually a doctorate degree. Towards the end of my time there at LSU and my doctorate, I realized that science wasn't my love. I really enjoyed entrepreneurship. I liked business, and I liked helping people. And so I jumped into actually wealth management post-education and worked in business succession and estate planning in my own practice for 10 years. After selling that practice, actually went to work in private equity before founding Bridgeway Partners here with Mike. The real reason that I get up out of bed every day are those two kids on the right there, my fishing buddies. My goal in life is to be as important in their lives as my father was in mine, and that's why I strive to do every day. So appreciate you guys being here. Mike, I'll turn it back over to you.
Thanks, Tyler. One of these days, you're going to show me how to fish. Until that day, I'll stick to golf. But yeah, a little bit about me personally. I grew up in a small business. This picture on the left here, I'm only partially kidding when I say it was my first shift at the family restaurant, but it's not too far off. And that's really what exposed me to the world of entrepreneurship and candidly, how I knew I wanted to work for myself one day. And I don't know exactly when that light bulb clicked for me, but where I can tell you it wasn't was for many years before school, mopping the floors and cleaning bathrooms with my dad before work. The second thing that drives me every day is the middle picture here. That's my grandfather. In his late 20s, he left Italy to come to America with nothing but hopes and dreams. Didn't know the language, didn't have a job. And so what motivates me on a daily basis is nothing I do can be as risky, fearful as leaving your homeland and starting over from scratch in your late 20s. And giving any day less than 150% would be a disservice to him. And then the last picture here are the three most important, but also most expensive things in my life. My wife, who's an OBGYN resident here in Metro Detroit, and our two dogs, Tilly and Ollie. Professionally, I've been in mergers and acquisitions the entirety of my career, companies like KPMG, Grant Thornton, and most recently Mission Veterinary Partners. So we're going to start with the fundamentals here. what is private equity? It's a term that's used widely, very commonly, and candidly, it's become a bit taboo as of late. And the reason for that is there's so many private equity firms. There's over 6,000 active in the United States today. And with that and anything else at that volume, you're going to have the good, the bad, and the ugly. But fundamentally, how these firms operate, they have three principles or pillars, if you will. The first thing they do is raise money from investors. That's endowments, pension funds, high net worth families and individuals. They take that money and they put it to work, ultimately buying with the goal of operating and growing companies, de-risking the business by adding a board of directors who has the experience in the industry, leadership, the know-hows of how to scale a business, adding capacity, so putting more capital to work and expanding operations geographically or within its existing footprint, pursuing acquisitions, and building out an executive leadership team. All of those things make the business less risky, making it worth more money, and ultimately their goal is to sell that company at a later date for increased value for shareholders and their firm. Now, a question we get asked a lot is, who does private equity sell to? And from the outside, it can be a little bit challenging to distinguish between the lines of what this ecosystem, or what we call the food chain, looks like. And so what we see a lot and who we work with a lot are lower middle market firms. These firms are the one doing the platform creation. They're buying the $1 to $2 to $3 to $4, $5 million EBITDA businesses, and they're bringing them together under one brand. They're building out that first layer of executive leadership. They're putting in place early technologies. They're doing the gritty work to bring 8 to 10 brands together under one umbrella and make them a unified business while keeping their local brand equity. Those firms, I'm sure you've heard of some of these, Shore Capital and Alpine, are in the lower middle market. Typically, what will happen is after they've established a platform that's operating well and is ready for the next partner, they'll transact or transition that business to a middle market private equity fund. These firms have more capital at their disposal, will write bigger checks, and candidly has the expertise of taking a business from, say, $25 million of EBITDA to 100. And so they can continue to grow with that business. Ultimately, after they've achieved their goals, they're going to look to transact that as well. They could go adjacent to another middle market firm who maybe is eager to get in the industry, or they can move upstream into an upper middle market or a large cap fund. And they ultimately desire to exit via an IPO to a strategic, and sometimes even a buy and hold strategy. But there is defined players within the industry and a natural progression for firms to move through. And that's how private equity can realize value throughout the process. The question, the $1 million question, or millions of dollars questions, is how does private equity actually make money? And there's two standard ways in which they collect dollars on their investments, or return on their investments. One is what's called the management fee. It's much like what a wealth manager charges its clients to manage their assets. In private equity, the standard amount is 2%. So in this scenario, we're going to say a firm raises $500 million. They charge those investors 2%. They're collecting $10 million in revenue. Really, the intention for that is to build out an acquisition team, sales team, an operating team, so that they can not only complete acquisitions, but support those acquisitions in their growth journey. And where they make most of their money is what's called carried interest. So if we carry forward that example, and we say they took $500 million committed capital, they invested it, and now 7 years later, they've been able to exit all of those investments. And at the end of that, they turned 500 million into 1.5 billion. The first thing they have to do is give their investors the money back. They do that, they're left with $1 billion of equity value they had created through their investments. They share in that 20% to every 80, or 20% of every dollar that they give back to investors goes to the private equity fund. So in this scenario, they made $200 million. And now you can imagine that check size can go up significantly if they generate a higher return, if they're investing more dollars. And that is why investors like it, because your interests are aligned, right? They're making money when you make money. But also, this is why private equity has created one of, if not the most billionaires of any industry, because if they do their job correctly, the returns are significant and meaningful for these firms. Now, for those of you who have explored the rabbit hole of private equity, you've maybe talked to groups, you've invested, you've heard terms like general partner, limited partner, committed capital, fund, platform, add-on acquisition. And if you don't live it day to day, it can be a little bit tricky to understand maybe what all of those mean. So this is a visual illustration of how it looks and I'll walk you through each piece separately. So your private equity firm is the general partner, right? They're responsible ultimately for the operations of the business. At a high level, they're not in there turning wrenches, but they're responsible for it. They own it. Limited partners are those high net worth individuals, pensions, endowments who give the private equity firm committed capital and allocate that to a fund. A fund is generally a pool of committed capital intended to invest in a specific industry. So a private equity firm can have multiple funds, and they'll have an industrial fund managed by an industrials team, a business services fund managed by a business services team, et cetera, et cetera, et cetera. When those funds invest in companies, they're creating platforms. When those platforms go acquire more regionalized local brands, those are add-on acquisitions. Now, I'll give you a real-world example. There's been a lot of publicity around Guild Garage Door Company recently. Guild was the platform. Companies like Garage Door Doctor would be the add-on acquisition that folds into or comes under the Guild platform or umbrella. And for those who have continued to explore the rabbit hole of private equity, you've certainly heard the term rollover equity, or what is called the second bite of the apple. A couple things that I want you to take away from this slide, and trust me when I say we could spend an entire hour on rollover equity alone, but we'll skip ahead to just the important points here. There's what's called a waterfall. A waterfall is essentially just a list of who gets paid what and when. So on that, you have your debt and your equity structures. I don't think we need to get into the details of it, but you can have different forms of debt with different interest rate from different lenders. And at the very bottom, carrying the most risk, but the most upside, is equity. So when you're considering either an investment or a partnership, first you want to understand the waterfall. In other words, who is getting paid before the equity holders, and how much is it? And how likely is it we can pay them off to even realize a return on the equity? Once you get to the equity side of things, you now have to understand the cap table. Not all equity is created equal. Equity can have different restrictions, upside, options. And so it's important to understand where you're sitting on the cap table, and ultimately who gets paid first and what, and why you are where you are, and what incentives exist there. But also what's most important is to understand that equity can and has gone to zero in partnerships before, or can't be liquidated. Not all equity is created equal. Not all equity will grow. And so it's truly important, just like any investment, to understand what you're investing in, who you're investing with, and what has to happen for you to realize a return on your investment. I'm going to kick it to Tyler. I'm going to take a drink of water and let him walk you through what a typical PE deal is structured like.
Thanks, Mike. Before we talk about structure, we have to talk about valuations and how private equity actually values businesses. So we've already heard on this presentation a few times EBITDA. You may have heard that out in the real world when you're talking about private equity. All EBITDA is, it's an acronym, stands for earnings before interest, tax, depreciation, and amortization. It is a metric of profitability, and that metric of profitability of your business is what private equity will use to value your business. They will apply a multiple. Depending on the type of business, the industry you're in, those multiples can vary from 2s to 3s up to 5s and 10s even. But for this example, we're going to say it's a $2 million business, and the multiple that was applied to that EBITDA was 6, giving us a $12 million valuation on this business. The first part of the deal structure, and this structure is pretty normal, 90+% of deals are structured similarly to this. That the first portion of that is cash. So the $8 million of cash, this is the money that hits your bank account on the day of close. I can promise you will sit there with your phone in your hand, hitting refresh multiple times until you see these dollars hit the bank account. This money is yours. They can't take it back unless you have committed fraud in the marketing of your business. You'll be very excited when it hits your bank account. You'll high five. You'll probably go to dinner that night, and 24 to 48 hours later, that high kind of subsides, and then you realize you're going to have to pay some taxes on that. And I know Kevin and his team have got some strategies for that, so stick around for that later. Rollover equity is the next component. Mike's already hit on that. I won't belabor the point other than to say again, not all equity is created equal. So it's good to pick the right partner. The last part of a deal can be a growth earnout. I think growth earnouts get a really bad rap. from sellers because they think, listen, if this is the value of my business, why do I quote unquote have to earn it out? And we really feel that it is a good tool to align buyers and sellers. And the analogy that I use with our clients is this: you as a business owner have a viable business. That's a chicken, right? This is my analogy as a simple country boy. And so you also have opportunities in the future. Those are eggs. The buyers, the private equity buyers, they're really in the chicken business, right? They want viable businesses. They're not really keen on paying for potential opportunity in the future. What a growth earnout does is it allows you all to come together and to bridge the gap between you as a seller and your expectations of valuation and the buyer's ability and willingness to pay for your business. And what they will do is, as those opportunities come to fruition, i.e. the eggs hatch and turn into chicks, the private equity will pay you for that chick. And again, this is a really great way to align you and the buyer together. The other thing that I tell our clients is that if you pick the right partner, they're going to take your egg, your opportunity, they're going to put it in a really fancy incubator, which is going to have their marketing machine, it's going to have their recruiting machine, it's going to have their ability to train your team up, and the opportunity for those eggs to hatch is going to increase. I promise you, when a growth earnout is in place, the buyer wants to pay you those dollars, because all that is doing is showing that your business is growing and the asset that they bought is what they thought it was and it's performing well. So that is structure in a nutshell.
Well said. With that, timing also matters, just like any investment. And we alluded to it in the video earlier. There's more upside when you join earlier, but more risk. And the inverse is true later on in a roll-up or consolidation strategy. And so what we've done here is shown, the impact of joining early versus late. And the next slide, we'll talk about being right versus being late better than being wrong. But in this example, we're going to walk you through what it could look like to be the 5th acquisition at a platform versus the 20th. And so building on the 5th acquisition, at this point, you're very early stages. The platform probably has a vision as to what they want to be, but they're still building the plane while flying it, meaning they don't have the full executive team built out. They have some pieces, they might have had some turnover, they're still trying to figure it out. They don't have a proven recruiting engine. They don't have a proven marketing engine, but they have a good PE sponsor. You believe in the mission of what they're trying to accomplish, and you believe together you can go further than alone. And so you partner early. And now in that scenario, when you partner, you're taking a $7 million offer, 1.4 million of that's rollover equity. At the time, the share price is $4. So you have 350,000 shares in this company. Now we're going to rewind to the 20th acquisition, okay? When this group joins, they probably have a fully built out executive team. They've proven they can recruit, their marketing systems are working, they can retain talent, they have growth trajectory for their employees, they have diversified their risk across now 20 businesses versus before 5. And as such, the stock price has increased. So even if you take the same offer, both offered $7 million, both took 1.4 million in rollover equity. The 20th acquisition, the share price is $7.50 a share. They're getting 186,000 shares. You fast forward both of these a few years at recap, at sale, when your rollover equity becomes tangible and liquidated. The 5th acquisition is going to realize a 2.8x return, assuming they sell at $11 per share, which is 3.85 million. Much more upside, right? Because they took the risk, they joined earlier, they were part of the growth journey. The 20th acquisition, who joined closer to recap later on in the process at a less risky part of the growth journey, they're going to realize still a positive return, right? But at a lower level, 2.05 million or 1.5x return. Depending on the timeline between when they joined and recap, that could be great by all means. But it just goes to show there is value in joining earlier versus later if the timing is right for you. Like I said, being late is better than being wrong. And unfortunately, you'll see this in industries where there's a lot of consolidation happening. And mathematically, it makes sense, right? If you have 70 groups all with the same thesis, not all 70 are going to work out. And so what this example shows is platform A and platform B, let's assume they start at the same point in the same industry with the same goals. Different mission, different culture, different PE sponsors. Platform A grows strategically. They acquire the right companies with the right cultures and the right people, and they don't have to overpay to win these deals. and they're operating the budget. Now, when I say operating the budget, this is important both in beating and missing budget equally. Companies value, if you say I'm going to grow organically 4%, growing organically plus or minus 0.5%, not growing 4% more than you planned or 10% more than you planned, because that proves it's not predictable. That company is going to be able to recap to the next PE sponsor almost at their will, because they've proven all of the things that make them valuable. They're disciplined, their culture is great, the teams like them, they can retain talent, and that's going to be a great return and an exit for its investors. Platform B wants to move too quickly. They don't have the structure in place to support it. They're overpaying to win deals. They're acquiring poor cultures because they do not have a good diligence process. And ultimately what that leads to is their assets start to struggle. They're losing talent. They're facing issues with their debt covenants. And they're either going to be forced to shut down businesses, but ultimately they're going to be stuck digging out of a hole, unable to sell or recap to generate value for their investors. And if they do, it's going to be at a heavy discount because people aren't valuing what they've built. In this world, it's super important to understand the difference between building an operating company versus stacking together EBITDA and hoping to do it fast enough to get a return before you actually have to operate. And here at Bridgeway, we're proponents in the right role of equity because we've seen the outcome it can have for a business owner. And we wanted to give you an illustrative example of what it can look like and why we think it's important to consider as part of your asset portfolio. And really what that is you get access to an asset class far before it becomes available to the general public. And so this example, some of you may be familiar with this story because when KKR sold CHI, there was a huge employee distribution. But just for the sake of illustrative purposes, the first acquisition of CHI was in 2010 for $300 million. There was a 5-year hold period, the company grew, and then FFL sold it to KKR in 2015 for $685 million. KKR would go on to do great things with the business and ultimately exit in 2022 to Nucor for $3 billion. What I want to call it here is from initial investment in 2010 to later on 2022, the enterprise value increased tenfold, and that equity has still not become available to the public markets. And so a lot of the growth on that investment has already occurred before it becomes available, if ever, to the general public. And so there's a ton of meaningful upside for business owners and investors alike to get in early and realize that when it might not always be available. Now, if you're a business owner on this call, you might be wondering, how do I exit with confidence to PE? And I won't go through this slide in much detail, but we do think it's incredibly important to run a process to exit to PE for a few reasons. A, it's how you create competitive tension to maximize your outcome, but B, it protects your discretion. And what I really mean by that is versus picking up the phone with one buyer and acting on that one call, you get to see what's out there. You get to understand who values your business, who's interested, and what they're willing to offer. And the conversations you're having now can be much more intentional because you're aligned on valuation, you're aligned on structure, you're not having to have 80 discussions. You're able to strategically weed out some of the groups here. And ultimately what that does is when you do exit one day, you can retire with peace of mind and clarity, knowing you saw your options and you made the choice at the time that you felt was best for you, your family, and your team. And something with every partnership is going to go wrong. And the first time something goes wrong, you don't want to wonder, what if? What if I talk to other groups? What if I took a different offer? You want some surety around the partner you choose. Some common things that you can ask a partner to understand if really they're going to be a good partner or if maybe there's some red flags you should double click on. This is not intended to be an exhaustive list, but it should give you a good idea, or at least get the wheels turning on questions to ask these groups. One being is, are they willing to share up-to-date financial statements? Or are they sharing heavily adjusted pro forma income statements, not much detail, and that doesn't give you much insight as an investor, whether you're rolling over equity or putting in capital, as to how the business is truly operating and where it's going. Will they share contact information for their last 5, 10, 15, however many you're asking for, acquisitions? Or do they want to give you a filtered down list to protect maybe you from hearing some not so good stories from former sellers? Do they have a clear, articulate plan for growth? And can they show you their progress towards goal? Towards the goal. It can't always be measurable, but are they putting people in place to run the programs they're talking to you about? Are they budgeting for the programs they're talking to you about? Are they executing once they are able to put these things in place as they would intend? Or do they not have a clear, defined plan to achieve these goals? And this one's important because I think the red flag can almost stand out as a benefit to some, but it's really something you should understand more. And that is detailed integration plans with timelines and assigned personnel. Now, it can be overwhelming at first, trust me, in a partnership. When you sign an LOI and within a few days you send a huge diligence list, and someone's trying to schedule a meeting with you to walk through these things to make sure you know the timeline, when they need certain things, how to access them, etc. But it is truly a blessing, because what you don't want when you're transacting or picking a partner is to hear we integrate slowly, you won't even notice a change. Either A, it's misleading and you're going to notice a big change and quickly, and you're just going to prepare for it. Or B, you're not going to get the resources you had hoped for or wanted in a partner to help you grow your business and successfully allow you to exit now or in the near future. To that point, what makes a platform valuable? And so we hear it all the time, the term, and maybe you have or haven't heard, I shouldn't assume, multiple arbitrage. Part of the thesis in consolidation or roll-up strategies is the platform of all of these companies with integrated leadership and technology is worth more than a standalone business, which can be the case. But really what makes them valuable is their ability to recruit and retain top talent. So it's proven. There's a playbook behind it. They have preferred vendor rates and pricing. There's a benefit to economies of scale, and they've acted on it. They have clean technology stack. What that really means is all of their operating companies are using similar or the same technologies, and at the corporate level, they can see detailed statistics, KPIs as to how the business is performing. Strong executive teams. This one's really important. Do they have a well-built out, well-tenured, experienced executive team that has proven they can lead the business? Repeatable acquisition and integration, like we talked about. Have they proven they can buy the right assets at the right price and integrate them successfully? A way to measure that is that they don't falter acquisition or go backwards after partnering. And then consistent budget attainment. So they're not going too far above or too far below, and they're living up to their word in terms of what they're promising on an annual basis to their investors. Now, like I mentioned earlier, private equity has become a little bit of a taboo term. With that, there's a lot of myths, if you will, that circulate. And some of the most common ones we hear are, they'll fire my team. I can't say it hasn't happened, but the right partner is buying your company and partnering with you because they believe your team is what makes it special. And they want to do everything in their power to retain them. Now, like I said, that's not every partner, that's not every group, but the right group sees the value in them, and that is not and should not ever be their goal. My equity will be worth 3 to 5 times in 5 years. Maybe, but not all equity is created equal. It can and has, and certain companies, gone to zero. And you need to understand what has to happen for that actually to occur, and are they on track with the resources to do that? And they'll make it too corporate. Yes, I will be entirely honest with you. They're going to bring process and protocol to your business. They, to put it simply, have to, because if they're going to own 50 to 100 brands across the country, they can't have 50 to 100 different ways of doing key things. Now, there's going to be things that are unique to your company and your brand, and that's okay. But there's also things that have to be consistent, have to be repeatable, both from a training perspective and just from a management perspective. And if your company already operates with the system accountability, with metrics, with technology, there's going to be change, but not a disruption. Kevin, I'll go ahead and kick it back to you. Take over on the Ausperity side.
Yeah, absolutely. And I think that was great. And again, that's what we really want here is for, our clients and, prospective clients as well to be educated on private equity, right? As a business owner, as you're going through this process as well is what is tough is you're also running the company, right? So you're still running your company on a day-to-day basis while having these conversations with different private equity groups, and it becomes extremely overwhelming. You have your family as well, as well as this is a new process, right, too. So you want to have people in place and, people that are doing this every single day. And that is the importance of having a financial advisor like Ausperity, having a group like Bridgeway Partners to minimize those mistakes, again, because they see it every single day. He's doing over $1 billion in transactions. Again, You want to have people where you've seen the mistakes be made, because you can't always quantify it early on, but those little things can be the 6, 7, 8-figure differences from day one, as well as, potentially in that roll up period in the 3 to 6+ years later. So again, you want to have that piece in, as well as your understanding it's a partnership, right? So like understanding you are becoming partners with these people, and you want to have the teams in place and have good synergies on just the philosophy, as well as understanding you're going to having these conversations later on. So I really started my career, I've been working with business owners my entire time in my career, starting with a firm in the area where it was about 90% privately held business owners, as well as from there working with A-list celebrities, as well as private equity individuals themselves. So I've seen it from both the business owner pre and post exit. I've seen working with the private equity individuals as wealth management clients, as well as our clients, over at Ausperity. We do have a large philosophy on investing in alternative investments. So what you just heard on is for business owners going through the process. It's also for the ones that aren't business owners, how do we get a piece of this action in a lot of ways? So I've, again, had the process of doing it. I started and sold a vacation company in 2023. With that, again, is understanding the empathetic side of, what this process really looks like, going through it. For most people, it's a one and done, that not many people are serial entrepreneurs. So this is the first time going through the transaction, and likely the last. So again, you want to make sure you're doing it right. So a lot of people, again, in this process is they understand where they actually are today and where they want to be and how to get there, right? And a lot of the times there's large gaps in between that. One of my favorite quotes is Mark Twain: "Ain't about what you know that gets you in trouble, it's what you just know for sure that just ain't so." Again, for people who see this, it's very often the case that you might have heard a couple stories, maybe one of your buddies in the similar industry has went through a transaction, but you might only be hearing the good and bad parts of that story, and maybe not the whole thing. So again, in that process is, if I sell my company, can I truly retire? At what price can I truly retire? And that's where the coincide of both, Bridgeway Partners and a group like Ausperity is understanding, if I sell the company for X, can I retire spending Y? And what will that roll-up period truly look like? And having the team in place through that transaction. So again, we want to make sure to close this gap, because we see it commonly of people think their business is worth X, and then they go through the process and realize it may or may not truly be that value. And if it's not, can they truly retire today? And ultimately for the business owner clients, again, pre and post exit, I just want to understand for people who aren't clients of Ausperity is the business owner, we are not that person who you are is typically still the biggest asset. You are still your biggest asset, going into the business, working on, increasing revenue, focusing on that EBITDA number, and what that will do as you continuously grow revenue to get that large exit dollar, right? But what we do is have groups like Bridgeway Partners, really good CPAs in place, business attorneys, as well as estate attorneys as well. What the insurance sides look like. Do you have a buy-sell agreement in place? Do you have life insurance? All those pieces together, we essentially are that quarterback in this transaction, as well as the lifetime client that you're having on that side as well. So, we're doing our side as the financial advisor, but we're really also being that quarterback, working with the different teams. And if you don't have, for example, a CPA attorney in place, who to truly work with, who do you really want to trust in this industry? Again, a lot of this is a trust side. So, what we want to do is complement you as a business owner with the, outside advisors to have essentially that Avengers team, we sometimes say, in place for you to, again, minimize mistakes, do what makes sense for you and what lines with your goals and objectives as well. And that's, again, what this is really saying is crystallizing those goals and objectives. From our side is what this looks like from the tax planning side. Again, you're going through what I've seen in a lot of these times is you got to understand is when you have this exit and that wire hits your account, there's typically a pretty large tax bill that's coming. Uncle Sam is banging on the door for you. So there's times where people spend or essentially owe more in taxes in that singular year than they've potentially paid in taxes their entire life, right? For, the right price point. So again, what that looks like today, what can we take action in April and not wait till next March to say, what could we have already done? Again, we've had a lot of clients talking to us today of now just recently paying their tax bills and saying, I wish I could have, right? So what we want to do is engage early as possible in the process and understand what makes sense from you from the tax perspective, what cash flow planning looks like. When you do sell the business, do you want to buy, for my Jersey Shore people, a shore house? You want to buy the house in Florida? Do you want to give gifts to kids? Are you now, you're at this point where you've always been charitably inclined, but now with this large transaction, how to gift strategically from both a tax perspective as well as what, groups you want to gift to and how to most effectively do it. And again, the continuity side is really the business side of a lot of what we talked on today. Estate planning on, what we can gift today, the estate tax potentially to have on both the federal side as like, New Jersey as well has an inheritance tax as well. And once we understand that full picture together and where you want to go, that's where the investment planning comes into play. And that's where we think Ausperity is a little bit different of a type of advisor, where we're built for operators. The old model is really that portfolio managers, we're just going to pick individual stocks for you. And that's, at the end of the day, the service that you're getting is someone who's picking individual stocks and acting more reactive than proactive, more product driven versus aligning with what you truly want. That's why Ausperity is an independent firm and built the way that we are, is we want to provide the best advice that makes the most sense for you and have the right people in place. So again, after tax is important. If I get this $10 million check, how much am I truly netting? What can we do to reduce that number in 2026 or 2027, 2028 when this transaction happens? And having the tech on our end is just to make sure we're getting this full picture, right? All of our clients have built out financial plans where they can log into their client portal and see their net worth is today. And then we run a lot of different scenarios on what that will look like on potentially some life-changing money. And that institutional access on that same boat is our clients are for, the ones that are aligned on investing in private equity. All what Mike and Tyler just talked on that early years of getting that juice of that 10x return in that example. Not to say that companies like NVIDIA continuously go up, but to the same degree as there's a lot of growth for that $30 million company to get to $300 million to $3 billion and participate. And we believe in, again, the private market to get our clients access to it. I mean, a great statistic is 87% of private companies doing over $100 million are private today. So how do you get access to that and participate in that as well? So again, what we try to do is be that capital strategist, understanding where you want to be today and where you want to go. And that's where, again, a lot of this becomes in the bucketing approach and understanding for the portfolio management side, right? A lot of these investments now sound great. How do I get more allocation to private equity? Now, if you have short-term, you want to do some renovations on your home, you have some college expenses coming up for the kids or grandkids as well. You want to make sure, you have cash reserves on that same degree. So what we do is build out for our clients. We want to make sure if there's sideline cash needed, that it's available, because in these investments is, for our clients and prospective clients to understand is that there's typically lockup periods, right? Where this is a private investment at the same degree that you can't just sell it the same way as stock is. It's almost, for people to understand, most people in their property and real estate, yes, real estate prices went up a ton, but it's not like you can find that buyer tomorrow and sell your house. There's a little bit longer of transaction that needs to happen so it's not the same way as the traditional stocks and bonds, but that's where we find this still to be very complementary to the portfolio. So one idea to have as well, just to kind of finish this off as well, and then we'll do some Q&A, is what we've been finding a lot for clients is something is called the custom direct indexing. So instead of owning the S&P 500, when we've just had all this talk with Iran, the market recently, having a little bit of a downturn, instead of just absorbing the shocks, blows up of the ups and downs, that you are able to own the individual stocks instead of owning the ETF. On the left side, it's saying, essentially instead of it just being stuck in all the group of portfolio together, you are owning the individual stocks. Statistically, 37% of stocks are actually down in any given year. In years with more volatility, those are opportunities to take paper losses, right? Our classic, example is you sell Home Depot, you buy Lowe's, things on that degree. So you're able to take those losses as an idea. This is, again, one of many ideas that we do for clients, but we want to make sure, on that same degree that you're able to be invested and participate in the equity market, but also be able to reduce your taxes. So this, again, is just one of the many strategies that we do for clients, especially in years where liquidity events and large tax bills are a little bit more lumpy than your traditional year. The other piece to this as well is, let's say you're expecting the transaction to happen in 2028, your carry forward losses continue. If you just want to take the maximum $3,000 in losses in 2026, additional losses that you have are going to carry forward indefinitely. So again, this could be an opportunity to continuously take losses over the next couple of years where you're anticipating a liquidity event to happen. Again, this is where having an advisor in place is where we want to be proactive, not reactive, in what we do for clients. So I'll open that up for a couple more minutes of Q&A. I know Mike and Tyler went over stuff, and a lot of this is on the private equity side, educating everyone here. So it looks like we just have one question come in. Yeah. Have you worked with several private equities as HR professional, and some of the taboo view in real terms of how some people treat and related processes, low interest, particularly in years post-buy? You noted the good ones focus on talent, but my experience is less frequent. So does becoming a key insight needed as deal progresses if people matter?
I think what they're asking here is, if that's important to you and if you really want to discern if they care about people or not, it's understanding what programs they have in place. And the good groups have emerging leader programs, bonus programs, management options for them to be involved in equity pools. And so I think it is really important. That's okay, Doug. I think I'm picking up what you're putting down. But it's just a good point to understand, don't believe the headline narrative if that's part of their pitch. Drill down and ask what questions they have to support what they're telling you.
One more question before. Can you explain the carried interest risk? There seems like a lot of interest in taxing that.
Yeah, and Kevin, you might be able to do so just as well as me. Right now, carried interest, I believe, is taxed as a long-term capital gains versus ordinary income. So for private equity professionals, there's a huge tax advantage in earning a bulk of their income in the form of carried interest versus ordinary income, W-2 income. And so that's what a lot of the hoopla about in the media is pushing to tax it at ordinary income versus long-term cap gains.
All right, great. Again, thank you everyone for joining. Feel free to, ping us as well. If you want to give us a call or send us an email with one-off questions, we're happy to field those as well. Hope everyone enjoys the rest of their day, and thanks again for joining.
Thanks all.
Thanks everybody.